Welcome to another episode of Equity Mates. It is Thursday and we are here to talk through some ways that investors or beginner investors can learn in the markets. My name is Bryce.
I was wondering where that intro went.
My name is Bryce, but and as always, I'm joined by my equity buddy Ren. How are you?
I'm good, Bryce. I'm good. Look, as you said, we came across an article on Livewire recently. 5 ways young people can learn to invest, not gamble in shares. Now, we're not as young as we used to be. I certainly don't have the hairline of a young person.
You certainly don't.
But look, we thought it was a really good article. We thought it made some good points, and we thought it was worth bringing those points to the Equity Mates community. And so rather than us talking about it, we've actually got the author of the article to join us today, Dan Miles, founder or co-founder of Innova Asset Management. Welcome to Equity Mates.
Thanks very much for having me on, guys.
So, Dan, you've got, the article walked through 5 sort of key points about how young people can learn to invest and not gamble in the stock market. So we thought we'd just spend a couple of minutes running through each of them and getting your thoughts.
Yep.
The first one is to consider who is giving you advice, and in an industry where there is advice everywhere, I can imagine that's pretty tricky.
There's information all over the place, right? And you need to consider where it's coming from and what their particular bias is and why they're giving you that advice. Because it's very rarely, it's very rarely...
Impartial?
Impartial, yeah. Impartial is a nice way of saying it. So usually there's some kind of commission or there's some sort of conflict in the way in which they give that advice. So it is difficult because there is just so much information out there. And what is relevant for you is based on your own goals and being able to filter through that. So ask the question, who is it that you're getting the information from and what is their modus operandi? And that is a key point as to whether you would take that information on board or not, or whether it might not be particularly useful for you as a starting point. I mean, it may not be useful, the information in the first place.
Yeah. I think there's a bit of a cognitive bias around paying for advice as well and thinking that that has more value than if you were to read something online or for free.
There is.
Do you have a...
Yeah, no, there certainly is. And some of the best information I get is free. And I often hear that a lot of my fund manager peers will say, advice is worth what you pay for it. I don't agree with them. I pay a lot of money to get access to some very sophisticated data and advice. And I can tell you it's no better than some of the stuff that I get for free or that we analyse and produce ourselves at fairly low cost. So just because something's free doesn't mean it's bad advice. And just because you paid a $40,000 a year subscription to it does not make it very good. Yeah,
I like that. So speaking of knowing the value of a dollar, the next point was understanding valuations. Critical lesson that is probably quite relevant in today's market environment.
Couldn't be more relevant than now, absolutely. Look, understanding what the price it is you're paying for, because we talk about the quality of an investment and everybody wants to own a quality business or a portfolio of quality companies or a portfolio of quality assets. But if you overpay for them, you're not going to get a good return on them. And now, you may not have heard of this, but there's a concept called the Nifty 50, which people today know as the 50 stocks in the Indian market. But in the 60s and 70s, they were the blue chips of America. They were the Coca-Colas. They were the Johnson & Johnsons, they were the Walt Disneys, the Revlons, the Black & Deckers. Those companies were absolutely bulletproof, but people overpaid for them. And so if you'd bought them in the 50s and 60s, it wasn't until the 90s that you'd gotten your money back, right? And these are bulletproof companies earning, they had solid earnings. These are not, tech companies that have a promise and a hope and a whim. These are companies like Gillette, and you made no money on them for decades. So you need to understand the valuation. Now, how do you go about doing that? Well, there's various valuation metrics. We probably don't have time on the show to go through that, but if this goes well and you guys want me back, I can talk about valuation metrics and ways to do that, because there's no one way of doing it. But valuation matters because the father of value investing, people think is Warren Buffett. It's not. It's his teacher, a guy named Ben Graham. Yeah. So Ben Graham used to talk about buying companies. He would buy crappy, rubbish companies, but he'd buy them for a lot less than what they were worth, and he'd sell them for what they were worth, and he'd make a lot of money out of it. So you can buy a piece of rubbish, but if you pay less for it from what it's worth, you can make a lot of money. But you can buy a phenomenal business, but if you pay more than what it's worth, you'll lose dough.
Yeah, I think a very important lesson for beginner investors, because you look at, especially tech, how it runs, and you think you can pay anything for it, and yeah.
And right now is the most important time to be thinking of that, because the share market is the only market in the world that when the price goes up, everybody wants to buy more, and when the price goes down, everyone's looking for the door. It's the other way around in every other market. When things are on sale, everyone wants to buy them. When things are too expensive, they don't want them. And it's the complete reverse in the stock market. So keep that in mind. We are at all-time highs and at all-time valuations on many, many things, and that scares me.
So as a beginner investor, it is easy to get carried away in FOMO. It is easy to get carried away in stock tips from your mates. The third point you've got here is to know what you're investing in and to understand the risks.
I'll give you the best example of this was a colleague of mine contacted me in 2020 and said the oil price was down around the $20 mark, right? And he said, I want to buy some oil. I can buy an oil ETF. And I said, well, no. And he said, why not? And I said, well, because you're not actually buying barrels of oil. And he said, yes, I am. And I said, no. Look, if you buy a gold ETF, if you buy the right one, you are buying allocated bars of gold that are held for you in custody by JP Morgan in England. So you know that they are gold bars, and how the spot price moves is what you move. If you buy this gold ETF, it doesn't. It buys futures on the oil market, okay? And I'm not going to go into the jargon of contango and backwardation and futures markets, but to put it simply, if the oil price today is $60 and you go in today and they've just rolled over their contracts, they have to buy futures contracts to fill your position. Let's say they buy 1 month out futures contract, and it's $70. And you're right, and the price of oil in the next month goes up 10% to $66. Guess what? You just lost $4. Not because you were wrong, because you didn't know what you bought.
Yeah. I
Pretty
think it's
straightforward.
a very important one, especially with the volume of ETFs out there and how they're constructed. You got to know what you're buying.
Yeah, and if you look at the proliferation of ETFs in the US, it's way more so. I wrote an article in 2018 on an ETF where it had gotten to, I won't go into the details of what it is, but it was basically a derivative of a derivative of a derivative, and I would have to get into a lot of jargon to be able to talk to it in time, but I wrote this article on, because I thought it could actually bring down the entire futures exchange, but after my research I realised it couldn't. But I then wrote a footnote. It was a 12-page article. I can send it to you guys if you're interested. The last 4 pages were what's more likely going to go wrong with it. I published it, and the next day it word for word went that exactly as I pointed it out, but it had a market cap of billions of dollars, and there are waitresses and waiters and taxi drivers and stuff who had all bought this thing because they didn't. And there was a guy who was famous for leaving his job as a Target shelf like guy working in retail, had become a millionaire following this strategy, wiped out to zero because they didn't know what it is they were investing in.
Yeah. So the next one is an important one, but it's one that I think a lot of people often overlook or misunderstand. It's defining your investing goals. So I guess what do you mean by that? And maybe how should beginner retail investors think about setting an investing goal?
I put it into, I've listened to some of your podcasts and seen some of your shows, and I think you guys are doing the right thing by telling people to think about things in buckets and to think things in core and satellite and in different time horizons as to what they want to set it apart for, right? Most of the investing and actuarial community poo-poo the idea of buckets because they say, oh, you put it all together and you end up with a balanced type portfolio. Humans are designed to think in like different accounts. I've got 7 different accounts for 7 different reasons. Yes, I could put them all into one cash account, but I can't manage the cash flows as easily. When you define your goals, I would say that you define your goals based on time horizon and priority, and those things that you have to have, the things that you want to have, and those aspirational things that you would like. And in general, not always, in general, those must-haves are usually in the really short term. The like-to-haves are kind of at a later date, and you can probably take a bit more risk on, but you can't take a ton of risk on, but you've got a longer time horizon on. Those aspirational goals, if you don't get them, they're not the end of the world because you've covered the other two areas. But if you get to them, they're fantastic, and you can take a longer time horizon. And if there's a hiccup along the way and you have to draw out that time horizon because they're aspirational, that's okay. That's how I think about it in terms of priority and duration. And you talked about having 3 months or so of living expenses set aside. I've got 3 to 6 months worth of living expenses set aside in cash. So when COVID came along and I heard about people, having less than $100 to live off, I'm like, well, if I lose my job, I know I can, besides the fact that I've got insurances in place, I can live for the next 6 months before I can draw an income. But I did that purposefully because I would always set aside money, and it was there for that. And then there was the money that I would invest in. And the easiest way for people, if they're new investors, and keep it really simple, have some cash flow that you need, do a budget and say, I earn this much and I spend this much, and if I spend everything I earn, okay, fine. Do I have, if I save a bit, am I saving for a house? Well, if I am, and I want to buy it in the next 3 to 5 years, I probably can't afford to put that in the stock market, right? But I could put it somewhere that I can get access to put down on a house. So why don't I look at my retirement? Because I'm probably not going to touch that for 40 years. What do I want to do with that? Because that could be my aspirational goal. And then that's a longer time horizon, and then you can think about how you invest that differently.
Yeah, I like that.
So, Dan, to close out, the fifth and final, point is to keep learning, which probably for me is the best one, because that's what we're all about here at Equity Mates, is just continuing that journey. And if you even look at the Buffetts of the world, they're still learning.
They all are. Everybody. If there was a monopoly on how to invest, the best way to invest, we'd all do it.
Yeah.
Right? It's that simple, but we don't. So you keep learning. And so we talked about valuations before. Learn about what valuations are. So keep learning, and learning what's appropriate for you. Right? I study a lot and I learn a lot. And I've heard you guys say this on the podcast before, the more you learn, the more you realise you don't know.
Yeah.
And so that curious mind, having that curious mind to continually learn, will make you a better investor. Doesn't prevent you from making mistakes. You have to make mistakes. Like it's going to happen, because the market, you can't control the market. You can only control you. You can control your behaviour and your reaction to the market, which is why at the moment I look at our portfolios and look at the forecast levels of return on them, and everyone's really happy because our performance is so phenomenal, and I'm really depressed going, yeah, but what am I going to buy? Great, we've made all these clients money, but how am I going to make those sorts of returns for the next 10 years? I'm the guy who gets really happy in COVID because there's stuff I can buy. I'm the guy who's buying stuff in late March, early April with a big grin on my face because I had stuff held aside. But I only got there by learning and reading and making mistakes. I've outlined a couple of books here. There's a bunch more books that I could outline. And you guys are doing that job. You're helping that. And when you do that learning, go back to the first principle. Where are you getting your information from? Filter it. There's this idea of, do you want confirmation in your ideas? Well, there's a common behavioural bias called self-confirmation bias. When somebody agrees with us, we assume they're right, and if they disagree with us, we assume they're wrong. It's not really right. I can recommend a book that was written in the 1950s called The Art of Contrary Thinking. So people would think it would tell you how to think contrarily to everyone else and do the opposite. It isn't. What it does is it takes you through a mental process of going through your own analysis and coming to a conclusion, then taking all the other analysis and contrary opinions and taking it all together and then making a choice. And if your decision goes against the grain, well, then you're acting contrary, but that's what you do. But you've gotten your confirmation of your thesis, and you've also got the disconfirmation, but you've made an educated decision. You haven't made everyone agrees with me, so it must be right. Everybody agreed that Bitcoin was worth 18,000 at the end of 2018, and then it dropped 75%. And they now all agree it's worth 60,000. Who knows? It could be worth 20 million. It could be worth $3.50. I've got no clue what it's worth. But if you talk to someone and they just agree with you and you confirm it, you're not really learning anything, are you?
Yeah.
I think that's such an important point, especially when so many young investors are learning so much on social media. And social media can be incredibly valuable, like financial Twitter, a lot of smart people sharing a lot of interesting information. But the selection process of who you follow, what groups you join, you can just see these filter bubbles being formed. And I mean, you mentioned Bitcoin, and the crypto community on Twitter is a classic example of just confirmation bias.
It absolutely is. And remember, some of these communities are actually used for pump and dump schemes, just jazzed up in a different way. Renee Rivkin was caught, and so was a young gentleman in the US, for buying companies. And in fact, Wall Street did this, going out buying companies, then going onto forums and then talking up the prospect of the company while they were dumping it into these buyers. So you don't know who it is in the community and what their positions are. So filtering it out, and if they're very transparent about what they're doing and you can actually follow it through, well, then you know. But if you don't, then you have no idea if the guy is telling you that's a great stock idea is because they're trying to offload it.
Yeah.
Well, Dan, that is all we have time for today. If you would like to read Dan's article, it's called 5 Ways Young People Can Learn to Invest, Not Gamble in Shares. It is on Livewire. Search Dan Miles and it should come up. But Dan, thank you for your time. It's been fascinating, and I know there's a lot more to unpack, but that is all we have time for.
No problem at all. And if you can't find it on Livewire, we publish a plethora of information like this sort of stuff at anovaam.com.au. We've got one coming out probably tomorrow that I think you'll quite like, and you know, we do stuff like this for the everyday investor all the time, just to try and educate them, because you know, we've been around for a long time and have seen some really bad advice. So, you know.
Nice.
No, it's a good mission that you've got to try and help the everyday investor.
Well, it's part of our job.
So that's anovaam.com.au for more of that information. But that is the end of Equity Mates for the week. It's been a fun week as always. If you would like more information on what we do, you can head to equitymates.com. We're on all the socials, or you can email us at contact@equitymates.com. But otherwise, Ren, a new week next week.
New week next week. We'll be speaking to some more experts. We'll be bringing back Watchlist Wednesday. And we'll be talking about some of the news stories or some of the companies that have taken our interest. So hope everyone has a good weekend, and we'll see you same time, same place next week.
See you then.